The Key to Business Funding. A. Warner. Copyright 2018 Global Organizational Development Incorporated. Dedication. This book is dedicated to the memory of my grandmother Elizabeth Robinson Barfield, who always encouraged me to use my creativity. Acknowledgements. I would first like to give thanks to God for being my guiding force sustainer. This book or the work I do would not be possible without the motivation and support of my family. Special thanks to my Aunt Laura, who never fails to remind me continuously of my strengths when I need it most. And finally, to L. Peterson for his inspiration and encouragement. Introduction. Business survival requires funds. This book is designed to give you a step-by-step process of understanding how to build credit and obtain funding for any business. You will be learning first to understand the business credit system itself, then to know what lenders are looking for in order to approve a business for credit and funding, and, finally, you will learn where to go to secure funding for your business and know about the types of funding available today. Your business can have an excellent credit score and qualify for credit and funding without you having to offer a personal guarantee. I was first introduced to the world of business credit and financing in 2006 at the age of 23. At that time, I was the co-owner of a construction company and became interested in it as a way to invest in real estate as opposed to using my personal credit. I have since dedicated more than a decade to learning everything about how creditors and lenders do business. In addition to that, I have used unique proprietary systems to help consumers build and repair personal credit to qualify for lending. And I have helped business owners obtain funding. The knowledge acquired from witnessing thousands of loans being underwritten and how lenders make lending decisions has helped create one of the most advanced business credit building systems in existence today. This system has been used to help others obtain funding and build business credit for their businesses. We use this system to help our clients progressively build their funding needs, ensuring that they meet the underwriting criteria to get approved before they even apply. Now this book will give you the knowledge and power to fight and win the business credit battle. You are about to become a business credit master. You will know exactly how to build business credit scores and a business credit profile. With this business credit profile built, you and your business can obtain large amounts of credit and funding for your business without having to supply a personal guarantee and being personally liable for your business debts. These unique business credit building methods are also taught at the largest credit conventions in the nation to other credit firms. This book will show you how. My biggest motivation? Just to keep challenging myself. I see life almost like one long university education that I never had. Every day I'm learning something new. Richard Branson. Chapter 1. Business credit gives you power. You have most definitely heard of Equifax, Experian, TransUnion, and the FICO score before. In the United States, these have become household names. On the other hand, most Americans and even most business owners have still never heard of a DUNS number, Paydex score, IntelliScore, or even Dun & Bradstreet. Entrepreneur.com reported that fewer than 10% of business owners have any knowledge whatsoever of business credit. This is actually great news for you, because now that you are reading this book you do know about, and will thoroughly understand, the power of business credit. What's more, that means that the other 90% of business owners know nothing about business credit, leaving more money available for the smaller percentage who do, including, now, you. Most business owners quickly get accustomed to using their personal credit as a personal guarantee for their businesses. As a result, most never realize that it is possible to obtain considerable credit for their business with no personal guarantee or personal credit inquiry, hence, with no personal risk. Business credit bases approvals on the credit profile and score of the business, not its owner. The business owner's personal credit profile is not reviewed at all, because it's their business profile that is used to determine approval. The business is approved for credit, not the owner, meaning that in many cases there is no personal guarantee required. Personal guarantee. Most business owners currently use credit with a personal guarantee (PG). A personal guarantee is an agreement that makes the business owner in person liable for the business debts and/or obligations. With a personal guarantee, in the case of a default, the creditor can pursue the personal home, bank accounts, investments, and file judgments against assets of the business owners in person. No PG means the business takes on the risk, not the business owner. This keeps their personal finances safe and secure. One of the most common mistakes entrepreneurs make is using personal credit to finance their businesses. A recent study showed that 87% of all businesses mix personal and business credit. Common examples include paying for business expenses with personal credit cards and obtaining personal loans to finance business expenses. There are several severe, adverse effects on the business owner who does this. When an owner personally guarantees business-related financing, the lender will require a personal credit check. Every time an inquiry appears on an individual's credit history, his or her personal credit score takes are lowered. The lower the score, the harder it is to secure financing, and the more interest is charged. A further adverse effect of the business owner using their personal credit for business debts is that the more personal credit is used to guarantee a business, the higher the business owner's debt-to-income ratio will be. This means that in future financing lenders will only be willing to give less money. This obviously impacts on the individual's personal life. Signing that loan for the business could prevent the business owner from getting a mortgage or a personal car loan. When a business owner uses their personal resources or credit to finance a business, they chain their financial security to their company's success. If the company fails, the business owner is then left holding the bag, and their personal finances will be ruined along with their business. This reality is very practical, particularly considering that over 50% of businesses now fail in the first 3 years, largely due to a lack of access to capital. Each time personal assets are pledged for any type of credit extended to a business, the business owner jeopardizes their personal assets, including savings and investment accounts, cars, even their home. If the business can't pay off its debt, the bank will come looking for them personally to make good on the loan. It doesn't matter if the owner owns 25% or 100% of the business, the lender can pursue the person who supplied the personal guarantee for the entire business debt. A business entity established as a sole proprietorship is most susceptible to this risk. Although the owner can build business credit as a sole proprietor, they will be completely liable for all personal and corporate debt. Their credit history will be based solely on activity associated with their social security number because they will not have a corporate tax ID number. As a sole proprietor, they also have no legal means for separating corporate and personal credit. The best way to protect personal assets is to incorporate the business. Having done so, business owners can then shield themselves from personal liability for the company's debts and will typically also reduce their tax burden. Many business owners are unaware of the value of incorporation. Even fewer understand the essential steps necessary for building the kind of corporate credit that will enable them to take full advantage of their entrepreneurial status. Incorporation makes the business entity separate from the business owner, a separate entity with its own liability. Incorporation separates business assets from the business owner's personal assets. If someone decides to sue the company, they cannot touch the business owner's house, car, or anything else owned by them or their family. By incorporating the business is also enabled to begin establishing corporate credit, which will ultimately provide the funds needed to grow the business and one day get to the point where the business can obtain funding without a personal guarantee. Financial mistakes. Business owners typically are making big financial mistakes when it comes to business credit. One of the big mistakes is having the business not building business and financial credibility by building business credit. Another serious issue is the business owner contaminating personal credit and business credit by using personal credit for business debts. Investing personal credit and cash into the business without reporting to credit agencies is another big financial mistake many business owners make. They do have trade credit, but that credit doesn't end up reporting to the business credit reporting agencies and thereby allowing their business to build credit. Using personal credit cards, cash, line of credit, etc. to pay business expenses is another big problem business owners are susceptible to. This creates a big financial issue, as the business owner puts the family assets at risk of business debts. When this happens, the business owner is creating personal liability by pledging personal assets rather than utilizing corporate credit. Another major financial mistake business owners make is not paying their bills on time. In many cases this lowers the business credit scores, making it harder to get new credit at good terms. Most business owners also don't manage their business credit as they should, as an asset rather than a liability. A lot of business owners don't realize that business credit is an asset that grows with the business. But personal credit has a predetermined limit in borrowing ceiling, limiting what the business owner can be approved for. Building a strong business credit profile will help the business cash flow by reducing or improving vendor and supplier terms, credit card rates, financing costs and insurance premiums. There are many questions a business owner should ask to know if building business credit makes sense for them. Have I ever been declined for a business loan or financing? Could I use a business line of credit for working capital? Do I need, now or in the foreseeable future, to lease equipment? Am I currently stuck having to personally guarantee every loan? Would I like to obtain easy, fast approval on credit cards for my business? Do I currently receive the most favorable credit terms from vendors? There's an unfortunate lack of useful information available on how to finance a business, especially when it comes to building business credit that will allow a business owner to finance, operate and expand the business without putting their personal finances, or their family's very future, in jeopardy. When a business owner applies for credit for a business, most creditors will pull the business credit report. This credit might have been used for anything in the business from credit cards, to loans, to equipment, even to auto loans. When a lender pulls a business credit report and there is nothing there, they'll rely on the business owner's personal credit to guarantee the financing. And if there is no business credit file, they're not able to lend as much credit to the business as they would an established business credit profile. One of the main reasons a business owner needs a business credit report is the ability to receive more funding. One of the most important reasons it makes sense to build business credit is to save money. By building business credit, a business owner can save themselves and their business money. Building a strong business credit rating is vitally important to business success. Without it, the business owner will pay much more at higher interest rates for the money they borrow, if they can get approved at all. In fact, banks, which say they want to help small business owners, actually turn down over 97% of all business loan applications. They don't make it easy for a business to get approved. Let's look at a quick example. Let's suppose that a business needs $50,000 for a necessary piece of equipment. Without a strong business credit rating, their bank will only use the business owner's personal credit as a reference. If they get approved, they'll get in this example an interest rate of 18%. With a DB report, that business can lower the interest rate to perhaps 10%, with the business owner not having to guarantee the loan with their personal assets. Here's a quick comparison of the above-mentioned scenario. Personal loan, business loan, lease amount $50,000, interest rate 18%, 10%, term of lease 60 months, monthly payment $1,269.67, $1,062.35, total payment $76,180.20, $63,741.00, total savings $12,439.20. By simply building business credit and setting up a business properly, the business owner can literally save tens of thousands of dollars. When it comes to the bottom line, business owners must pay close attention to these kinds of savings. It doesn't matter how long a business has been in business, 1 year, 5 years, even 20 years. As far as the banks are concerned, if that business doesn't have a business credit rating, they are only going to lend a personal loan, with personal guarantees required for the business owner. This creates multiple issues, as the average consumer credit report gets just 1 inquiry per year and has 11 credit obligations, typically broken down as 7 credit cards and 4 installment loans. Business owners are not your average consumer because they carry both personal and business credit. This typically doubles the number of inquiries made to their personal credit profile and the number of credit obligations they carry at any given time, all of which negatively impact their personal credit score. Beyond that, because business inquiries and personal inquiries aren't separated on their personal credit report, their scores are, again, negatively affected. At the same time, by using their personal credit history to get business credit, they're not able to build their business score, which could help them attain critical business credit in the future. The key to establishing a business credit profile and score is to find companies that will establish credit for your business. Business credit basics. Business credit gives entrepreneurs a unique opportunity to build, maintain and acquire credit, both individually and for their business. That means business owners can build and grow their companies without having to rely solely on their personal credit. In the United States, when a consumer with a Social Security number accepts their first job or applies for their first credit card, a credit profile is started with the personal credit reporting agencies. This profile is consistently added to, with credit inquiries, new employment and address changes, new credit accounts, and other public record data. Eventually, the credit report becomes a statement of an individual's ability to pay back a debt. In many cases, the same is true for businesses. When a business issues another business credit, it's referred to as trade credit. Trade or business credit is the single largest source of lending in the world. Information about trade credit transactions is gathered by the business credit bureaus to create a business credit report using the business name, address, and federal tax identification number (FIN), also known as an employer identification number (EIN), issued by the Internal Revenue Service. The business credit bureaus use this compiled data to generate a report about the company's business credit transactions. In many cases, those issuing credit will rely on the business credit report to determine whether they want to grant credit to the business, and if so, how much and at what terms. To qualify for most business credit sources, the business must have a positive credit score established with the appropriate business credit reporting agencies. The major business credit bureaus that compile and provide copies of the reports are Dun Bradstreet, Experian Business, and Equifax Business. Once a positive business credit score is established, many merchants will then approve the business owner for credit in the business name. Thousands of major merchants offer business credit. But most don't promote their business credit programs, so they are difficult to locate. Some merchants offering business credit include Chevron, Dell, Staples, Lowe's, Visa, MasterCard, even large banks like Wells Fargo and Bank of America. Once business credit is established and paid as agreed, the business credit scores will continue to increase. As more positive credit history is established and scores increase, business owners can then be approved for even more credit with higher credit limits. With business credit, the business can even qualify for loans, credit lines, auto financing, even mortgages with business credit established. Business credit is an outstanding resource for businesses. Owners can obtain credit to run and expand their businesses without the personal liability of using a personal guarantee. Currently, information provided to the business credit bureaus is sent in voluntarily. No business is required to send it in. Therefore, in the case of most businesses, The credit bureaus never receive all or even any information. Many companies go years growing their business credit without any of it being reported to the credit bureaus. Because of the lack of reporting and promotion of business credit by the credit industry, many entrepreneurs are not at all familiar with business credit. Due to this unfamiliarity, many myths have been formed relating to business credit. Business credit myths. In some ways, a business has many of the same attributes as an individual person. Businesses earn income and file tax returns, debtors are paid, credit is used for the business, and many businesses have credit histories. Still, some business owners overlook the importance of a healthy business credit profile and score or don't know anything about business credit at all. Because of this, many business owners start believing the myths surrounding business credit instead of the real facts. One of the myths about business credit is that the credit isn't real credit with real merchants, or creditors. The reason for this myth is that although most major merchants offer business credit, most do not promote the fact that they offer it. There is no reason for a company to advertise they have credit where the applicant has no personal liability. For instance, Home Depot offers a commercial credit account. But in almost all cases, the applicant must be willing to provide their social security number when applying and is willing to take on the personal guarantee for the debt. So, it doesn't make sense for Home Depot to then offer the applicant a card with no personal liability if the applicant is willing to sign and give that guarantee and accept the liability. Yet Home Depot does offer business credit with no personal guarantee, even though they don't advertise it. Many merchants are the same, they offer business credit but don't promote the fact that they offer it. Business credit with no personal credit check or guarantee is available through Lowe's, Home Depot, OfficeMax, Staples, BP, Shell, Walmart, Sam's Club, Costco, Radio Shack, and thousands of other major merchants. But you'd never know it if you didn't look into it carefully. Another myth is that business credit limits and loan amounts are smaller than consumer credit. In reality, credit limits on business credit accounts are notably higher than consumer cards. A business owner can secure credit cards with 10,000 limits even after having a business credit score for only a few months. This is impossible to accomplish with personal credit. And with 5 to 10 accounts reporting on the business credit report, a business owner can qualify for multitudes of business credit cards with limits of 10,000 or higher. A business owner can build massive amounts of business credit much faster than consumer credit. And the interest rates and incentives are similar, if not better on corporate credit than consumer credit. There have been much news recently about the record incentives that corporate credit cards are currently offering business owners. These incentives are so good that corporate credit commonly has higher limits and better terms than most consumer credit accounts. Another business credit myth is that if a company pays all its bills on time, its credit history is strong and in good standing. Unfortunately, while paying bills on time is important, your timely payments only help your credit rating when your business works with creditors who report the payments to business credit reporting agencies. The secret to business credit is to locate and work with the vendors and merchants who work with the appropriate business credit reporting agencies. Over 90% of trade credit is not reported to the business reporting agencies. So even if you have many accounts set up with vendors, you still might not have a business credit score or profile established. The bottom line with business credit is that as a business owner, you can review the credit standing of your own business and take steps to strengthen or build your corporate credit file and obtain credit with no personal guarantee or credit check. Business credit benefits. Success in business will often be determined by whether the business has an established business credit profile and score. With a good business credit profile, the business will have near unlimited borrowing power. Lacking having a good business credit profile, it will find a difficult path to success, not having access to working capital and funding. This is why, according to Dun Bradstreet, a strong business credit file can be the difference between receiving business funds or not. Another reason for this is that approval for most small business loan decisions under $90,000 happen automatically and electronically, often relying solely on the established business credit file and score. Building business credit can improve business cash flow by reducing direct costs associated with financing costs, insurance premiums, vendor and supplier terms, rental terms and credit card rates. Business owners save money with lower interest rates on business loans. And they qualify for more loans, leases, and government contracts. Business credit eliminates the business owner's personal liability and risk in obtaining financing. It also separates the personal and business credit profiles so that both can be built to obtain greater amounts of credit. Business credit adds more value to a business and gives the business genuine business credibility. Stakeholders, partners, lenders, even potential buyers of the business will see more value if a strong business credit profile is built. This is why almost all Fortune 500 companies use their business credit to secure funding. It's not that they need the money to operate. Successful companies use funding as leverage to grow their business. One of the many benefits of business credit is that funding can be obtained with no personal credit check at all. Faced with a strong business credit profile, lenders will lend money based on the business credit, not the business owners. This is excellent if the owner has personal credit issues, as they will still qualify for funding despite this impediment in their private life. Even with exceptional personal credit, business credit gives the business owner double the borrowing power. They can get approved for much more credit and higher funding amounts using business credit than they would if they used their personal credit to qualify. A leader is one who knows the way, goes the way and shows the way. John C. Maxwell.